Good afternoon. Welcome to BizTech Asia's Midday Market Watch. I'm Jeffery Halley, and today on the 2nd of February 2024, we have as our guest Kelvin Wong, Senior Market Analyst at Oanda in Singapore. Kelvin, great to have you here. Good afternoon.
Hey, good afternoon, Jeff, and good to see you again.
Excellent. Look, before we get into the nitty-gritty, let's have a look around Asian markets today. We've had some pretty big tech results coming out overnight. Apple, Amazon, and also Meta. Some pretty sparkling results there that pushed up stocks ex-Apple after market close. That rally appears to have poured through, shall we say, into the Asian markets today. So looking at the Nikkei 225, one of the poorest performers though, down to 0.16%. Shanghai is down 0.72%. But elsewhere, it's all a sea of green. Hong Kong is up 0.62%. The S&P ASX 200 down in Sydney is up 1.42%. The Kospi in Seoul is up 2.35%, while the Straits Times in Singapore has rallied 1.1%, with Kuala Lumpur also climbing 0.47%. Now, Kelvin, if we look at the FOMC rate decision yesterday, that was as expected. They held rates steady, but it was all about the press conference, as is usually the case. And Jerome Powell pushed back quite strongly there about the pace of rate cuts, most notably saying that he didn't believe that a March rate cut, something the market had got very excited about, was on the cards. Do you think that the FOMC's decisions and the comments from Jerome Powell are enough to temper those bullish spirits in this huge equity rally that we've seen since October last year?
Yes, precisely. So I think for traders wise, as a short-term trader or technical trader, we'll be looking at the liquidity condition globally, especially in the US. Yes, we know that FOMC meeting, the Fed decision is pretty much key, as well, they are actually the driver of global liquidity. Yes. We know that Powell himself, during the press conference, he tried to tone down the optimism of this Fed pivot that has, I would say, put away that Fed dovish pivot, to be precise, has been in place since late October last year. So now all bets are off for the March rate cut. So do not forget over here is that what he sounded over here during the press conference is more of a balanced tone. He didn't actually kill off the Fed dovish pivot. What he did over here is to doge off market expecting, saying that, hey, I know that you guys are pretty much excited about the first rate cut, but we need to see more data to be precise, to be more confident that inflation has started to indeed inch down toward that 2% target. And he also did mention that he's pretty confident on the current pace of inflationary deceleration in US. So net, all in all, what we could see over here is that, yes, the US equity market didn't actually react positively to these remarks, because they actually sold off right after post FOMC press conference, down about negative 1.5% or so on the average across the board on the major US stock indices. But however, the treasury market reacted positively to this dovish pivot that is still pretty much intact. So if you look at the 10-year US treasury yield, actually they inch much lower right now, back down towards 4% level. Okay, so yesterday they continued to inch much lower to I think 3.85%, but way below this 200-day moving average. And also since middle of last week, they actually declined by close to 30 basis points. So net all in all, what it could seem is that the US Treasury market is indicating to us that longer term funding cost is still pretty much muted to the downside. So that could actually be also a positive catalyst for equity markets, especially in the US growth sector market that's pretty much dependent on leverage or funding to actually fund their business operation. So net overall, what I could see over here that as inferred from the US Treasury market, it's still positive for the benchmark US stock indices.
Right. Okay. We've had a very, very busy week, obviously, with the FOMC and some other central bank decisions and data. It doesn't stop today, though. We have the US Non-Farm Payrolls this evening to round out the week. What are you looking from the non-farm payrolls, and what are you looking for reaction-wise from the street?
Yeah, because if you look at the current situation right now, before I talk about the non-farm payrolls number, so since post-FOMC until now, market has been looking out for a weaker dollar strength, that means i.e. dollar strength being kept. So that was pretty evident, firstly, by a slowdown in US 10-year Treasury yield, inching downwards below the 200-day moving average, both the 2-year and 10-year, that actually reduced the yield, US Treasury yield premium against the rest of the world. So that actually feed on to dollar weakness. So dollar weakness, if you look at the dollar index yesterday, they sold off right at the test of the 200-day moving average again. So what we could see over here is market now has this dollar weakness narrative in play ahead of non-farm payroll, which is very important data to watch out for. So right now, market is actually tagging in an expectation of a weaker number versus last month outlier. So last month was kind of an outlier where non-farm payroll data came in at 216K. So that's above the average of about 200K for about the last 4 or 5 months. So market now is expecting 180K. So any numbers that is within 180K to 190K, I do believe that the dollar weakness may prevail. But any number that is shooting past 200K will start to actually see this dollar weakness starts to actually temper off again, where we may start to see dollar strength start to come back again on a intraday basis. So that could be a bit of a whipsaw scenario to take shape today. Yeah, if that scenario takes place.
Very much a Friday price action with the non-farms then potentially. Just briefly then, Kelvin, can we just touch on FX markets? The world's concentrating on equities, but there's stuff definitely going on in the currency markets. Could you just briefly give us an overview of the price action and the major currency pairs that you're seeing post-FOMC?
Yeah, precisely. So I'd like to talk about, especially after we talked about a bit more about Bank of England action yesterday, which is the UK central bank. So we could see over here right now, ex-post FOMC and ex-post Bank of England, the monetary policy decision, we start to see dollar strength weakness coming back into the picture. And this dollar strength weakness is pretty much prevalent, especially against the sterling. That means if you're looking at currency strength right now on a very short-term basis, the sterling is the strongest currency among the major versus the dollar. Then what's interesting over here is we start to see also yen strength coming back into the picture as well, given the fact that, do not forget, the Fed dovish pivot has not been killed off that we highlighted earlier, and also Bank of Japan is still on the mode of normalizing its negative short-term interest rate. That means, i.e., market participants are still looking for the removal of their policy short-term interest rate at negative percent territory to be removed in somewhere around the April to May BOJ meeting.
Thank you. Well, from one Oanda alumni to another, thank you so much for being on the show today and for your insights, Kelvin.
My pleasure, Jeff.
We've been speaking to Kelvin Wong, Senior Market Analyst at Oanda on BizTech's Asian Midday Market Watch. I'm Jeffery Halley. This video and podcast will be on our website, BizTech, www.biztech.asia, as well as our social media platforms. You can also see it along with our syndication partners, TV stations, radio stations, and websites. Thanks so much for tuning in.